Welcome to this explainer. Today, we're going to put on our value investing hats and really dissect the complex financial realities buried inside the latest Wendy's 10K and their Q1 2026 earnings reports. We're looking at this company strictly through the rigorous lens of fundamental analysis, peeling back the layers on their recent performance, how they allocate capital, and their true competitive positioning. Okay, let's just dive right in by asking Warren Buffett's absolute classic question. Is Wendy's a wonderful business at a fair price, or is it a struggling business needing a turnaround? You know, what Buffett might call a cigar butt with only a few puffs left. Well, to figure that out, we can't just glance at the stock ticker. No, we have to look under the hood at the underlying economic engine of the company itself. So here is our roadmap for this explainer. We'll walk through a six-part analysis. The fast food value trap, Wendy's competitive moat, management and capital allocation, inside the financial statements, the Q1 turnaround reality, and finally, our final verdict. Let's start with part one, the fast food value trap. To truly evaluate any franchise's health, we absolutely have to look at its average unit volume, or AUV. Basically, this tells us exactly what a typical single location is bringing in for its owner. This is literally the lifeblood of a franchise system. I mean, if the individual unit isn't highly profitable, eventually the entire system is going to feel the strain. And wow, this really brilliantly illustrates the uphill battle Wendy's faces. Sure, a Wendy's is cheaper to open than a McDonald's, but its $2.1 million AUV is almost half of what the Golden Arches generate at nearly $4 million. Burger King is trailing behind at $1.63 million, though they rely heavily on those budget-focused promotions. So Wendy's sits squarely in the middle, generating pretty modest franchisee profitability compared to those massive returns seen over at McDonald's. Moving right along to part two, Wendy's competitive moat. So here's the crucial point. Wendy's moat relies really heavily on its premium fresh beef quality and that super engaging, witty social media presence they have. They're fighting in the notoriously cutthroat fast food burger wars, boasting nearly 7,400 global locations. But here's their major vulnerability. That higher-cost, fresh, never-frozen model puts them at a huge pricing disadvantage against the value-driven giants. Right now, consumers are highly budget-conscious, meaning Wendy's premium positioning can actually limit its appeal. Plus, their smaller scale means there's just no way they can match McDonald's massive global advertising budgets. All right, part three, management and capital allocation. Looking at their track record, we can see management is actively pulling a bunch of different levers. They've been balancing massive stock repurchases, which originated from a $500 million authorization back in 2023, with heavy investments into operations, specifically their Project Fresh overhaul. They're also pouring capital into technology, like integrating AI recommendation engines right into their mobile app. And hey, that actually helped push U.S. digital sales up 8.4% recently. But what's really interesting is the current reality of those buybacks. As of the end of 2025, they were left with exactly $35 million in remaining capacity on that $500 million authorization. However, during the Q1 2026 earnings call, management specifically noted that no further buybacks are planned for 2026. Basically, they're keeping their powder dry. And you know, that capital preservation strategy becomes even more obvious when we track their dividend payouts over time. Back in 2023 and 2024, they paid out a full dollar per share annually. But then in 2025, that dropped to 67 cents. And for Q1 2026, they declared just 14 cents per share. We're seeing a clear downward adjustment in total annual dividends paid out to shareholders as the company shifts heavy capital toward its turnaround efforts. Now, despite that reduction, the stock currently boasts a striking 7.09% dividend yield based on recent pricing. For income-focused value investors, that metric is incredibly attractive. But as any seasoned investor knows, a yield this high often signals that the market is pricing in some pretty significant risk, which brings us perfectly to the raw numbers. Part four, inside the financial statements. When we pull the multi-year data from the 10K, it reveals a pretty stagnant reality. Total revenues just kind of hovered around $2.1 to $2.2 billion from 2023 to 2025. But look closely at the net income trajectory. It has steadily dipped from $204 million down to $165 million in 2025. This is happening under the crushing weight of higher commodity costs, labor inflation, and really intense price competition. And all the while, operating cash flow has stayed relatively flat. And that financial pressure, it spilled directly into Q1 2026, creating a glaring disconnect. Top-line revenue actually beat expectations. It grew 3.3% year over year to $541 million. But actual adjusted earnings per share absolutely plummeted by 40%. It dropped from 20 cents all the way down to just 12 cents. Company restaurant margins slipped down to 11.4% as falling traffic and inflation just ate right into the bottom line. Which brings us to part 5, the Q1 turnaround reality. Impartially speaking, the turnaround right now is really a tale of two entirely different markets. In the US, same-store sales dropped a painful 7.8%. They actually experienced a net loss of 174 domestic restaurants since late 2025, driven by intentional closures of underperforming locations and severe winter weather. But overseas, totally different story. International system-wide sales grew 6.0%, and they just signed a massive franchise agreement to build up to 1,000 new locations in China over the next 10 years. Looking at it visually, it is abundantly clear that the severe U.S. traffic declines, along with those intentional store closures, are heavily dragging down the impressive positive growth they're seeing abroad. Global system-wide sales ultimately declined 5.5%, simply because the U.S. market is just that massive of a piece of their pie. Now, management is definitely preaching patience regarding these numbers. CFO and interim CEO Ken Cook stated that they are in the, quote, early innings of their turnaround. The company is really emphasizing that sacrificing those underperforming U.S. stores right now and taking that short-term revenue hit is a necessary step to optimize long-term franchisee economics and strengthen the system as a whole. Finally, part 6, the final verdict. So, running through our Buffett-style moat checklist, Wendy's presents a classic value dilemma. Is it an understandable business? Yes, absolutely. But it operates in a highly saturated market. Favorable long-term economics? That's mixed. They're struggling with premium product costs and a much lower AUV than the market leader. Do they have pricing power? Currently, it's pretty weak, as they face heavy pressure from rivals pushing budget-friendly value meals. And capital efficiency? Management is highly active, offering a massive dividend yield, but they're dealing with shrinking net margins and halted buybacks. So as you digest this explainer and think about their bold international bets contrasting with those intentional domestic closures, ask yourself, are you looking at a wonderful business making the tough, necessary choices to revitalize its moat, or a value trap waiting to happen? For sure, keep your eyes peeled on those U.S. traffic numbers in the coming quarters. They are going to be the ultimate judge. Thank you so much for joining me for this fundamental breakdown.